We are moving to the third section, cost of capital. Okay. Now, see the capital which is provided to the company by the investors, capital providers, obviously will not be free. So there should be some cost to it. Debt provider, when he provides the debt, he expects something return. That return of the what we are going to pay to the investor becomes a cost to the company. Okay. So debt to the cost is called as cost of debt. Debt holders, whatever the cost to the company bears for the debt is called cost of debt. Similarly, preference shareholders, they will also not provide the capital for free. So the cost on the preference shares, okay, is called as cost of preference. Okay. So this cost, okay, whatever is the cost, okay, the we pay to the preference shareholder is called cost of preference. Same way, equity has equity cost. Retained earnings also has a cost. Okay, that also we will understand. All these costs are individual cost. That is, individual capitals have individual cost. Individual type of financing has an individual cost. What the company can do is they can calculate the overall cost of the company, and that overall cost is calculated by using weighted average method. So it is called weighted average cost of capital. I am repeating, individual type of cost, that is capital, has an individual cost. Debt has cost of debt, preference has cost of preference, likewise. Then overall cost can be calculated. That will be called what? Weighted average cost of capital. Okay. So please remember that whatever is the cost for the company is written for what? Written for the whom? Written for the investor. Okay. So there are different approaches which we have to learn. So right, section 4, section 3. Section 3. Cost of capital. Cost of capital. Now listen, how we will determine, first I am going to debt. Okay, how we will determine the cost of debt? Write the heading debt. Debt has two parts. Let us make it this way. Wait, I will write here debt, two parts. Irredeemable and redeemable. There are two types of debt. Okay, irredeemable and redeemable. Okay, irredeemable means what? Irredeemable debt.
Does not mature.
Yes, which will be there in the company, okay, till the liquidation. It is not redeemable. It can't be called back. That is called irredeemable. And redeemable means what? It has a finite life. Irredeemable means infinite. And redeemable means what? Which has finite life. Like after, let's say, 5 years or 10 years, you will call the bond. Okay, you will pay their money back. That is called redeemable. Okay. So what is the formula? Listen. For irredeemable debt, it is KD is equals to interest into 1 minus T upon net proceeds. NP means net proceeds. Have we seen this formula? Have we seen this formula? Yes or no? No? Yes. Have we seen it? Have we done this formula anywhere? Huh? There, there was what? No. What I'm talking about is where we have done this formula. Time value of money. The variables have changed. The notations have changed. Time value of money. Irredeemable means what? Perpetuity. Irredeemable means what? Perpetuity. Please understand. Think like this. Think like this. Interest. Why we are calculating 1 minus t? Because on interest we save the tax. Correct? If the company is actually paying 1 lakh interest, actually cash outflow is 1 lakh. But because of that, company is saving a tax. Correct? So interest is net of tax. Are you understanding? Correct? If it is irredeemable, means this interest will be paid for how many periods? For an infinite period. That means this is similar to installment. Yes or no? Installment in perpetuity was divided by what? Installment in perpetuity was divided by what? Interest rate. You remember? That interest rate is nothing but KD. Interest 1 minus T upon KD. Think, bring that feeling. Isn't it? This is what? Installment. Installment percentage, that is KD, interest. That we know. What we get? Present value of perpetuity. NP means what? Net proceeds. What you will pay today. Correct? Can you feel it? Yes or no? Interest means what? What is the interest the company is going to pay? Right? If net proceeds is not given, this is when NP is given. NP means net proceeds. Please write NP is equals to net proceeds. NP is equals to net proceeds. Make an arrow and write interest. Interest is in rupees. Interest is in rupees. Interest is in rupees. Okay. Next, redeemable means there is a finite life. Redeemable means there is a finite life. Okay. So understand what will be the formula. Finite life. KD is equals to KD. This is subscript K, and then D is written below that, subscript. Okay. Here also it is subscript. Don't make a mistake. Have you written, if you have written like this KD, it's wrong. It's not with beside the K. It is below the K, KD. Okay. I'll make it clear. It is below the K, KD. KD is equals to, understand, what is the formula? Interest into 1 minus T plus redeemable value minus net proceeds upon N, the whole divided by RV plus NP upon 2. Please copy this. KD is equals to interest 1 minus T. RV is equals to redemption value. NP is equals to net proceeds. Done. What is the logic behind the formula? Please understand. See, the cost to the company is written for the investors, correct? Interest is what? Income. For whom? Income for whom? Income for the investor. Interest is income for investor, correct? Right? RV is what? Net proceeds. Let's say the company initially it issues for 1000, but when it redeems for 1200. Let's say when issued that bond, it issued for what rate? 1000, but when it redeemed, so that 200, isn't it extra for the investor? That 200 is earned in how many years? That 200 is earned in over a period, let's say 5 years. So that 200 should be spread yearly, because the return what you take in the numerator is what? Yearly. Return what you take in the numerator is what? Yearly. Interest is yearly. So that 200 is also earned yearly. Therefore, what you should do, you should spread it across the life. Right now, have you understood? Are you understanding what I'm saying? Clear, na? So numerator is written divided by what? Divided by investment. What is the investment? We will take average. NP is extreme value, 0th year today. RV is extreme value, redemption after 5 years. What you should do? Average RV plus NP upon 2. That is the logic behind the formula. Is it clear? Return to the investor becomes what? Return to the investor becomes cost to the company. The drawback with this formula. Can anybody tell me what is the drawback with this formula? Great. Time value of money is not considered. Time value of money is not considered. Therefore, write this. Write this above below this. In this formula, it gives approx answer. It gives approx answer because TVM not considered. TVM is not considered. TVM is not considered. Full stop. TVM is not considered. Done. Sometimes what happens? Interest is given. Please write. Interest is given in percentage form. Means only percentage. No other information is there. Interest is given in percentage form. Okay. Write in bracket. Only information. Means in question. Okay. Interest is given in percentage form. Only information. No other information is there. Life is not given for how many years. Redemption value is not there. Nothing mentioned. Then how you will calculate KD? KD is equals to interest into 1 minus T. This is in percentage. Okay. Right, note. Same can be applied. This formula, which this one, same can be applied. Make an arrow. Same can be applied for term loan. It will become KT. KT is equals to I into 1 minus T. Can anybody explain me when to use this formula? It's just percentage. Means they will tell you debt is 15%, debt's interest is 15%. And tax rate is given. You have to calculate cost of what? Debt. So at that time you will calculate like this. Interest 15%, 15 into 1 minus whatever is the tax, 0.3. Okay, so you'll get after tax. We'll apply this in the sum. Okay. Come to question number C35. It's 252. There is a space left in the textbook. There also, while you practice at home, you should write it, these formulas, so that second time revision it becomes. Okay. It's a second time revision. Question number 35. Nominal value of the debenture issued is 10 lakhs. Means this is the nominal value of the issued debenture. This is the face value. The debenture carry interest 12%. Tax rate is 30%. Okay. Tax rate is 30%. So 12% will be calculated on what? Nominal value. Okay, 10 lakhs. Calculate the cost of debt. If these debts are issued at par, means if debts are issued at par means what? What is the issue price? 10 lakhs. Okay. So write first. At par. Give the heading at par. Okay, tell me. Did they tell you for how many years it is issued? No, they have not said. That means it is irredeemable. Life is not given. infinite. So right, at par, right, interest is equals to 10 lakhs multiplied by 12% is equals to rupees 1,20,000. Rupees 1,20,000. Okay. Net proceeds is equals to 10 lakhs. Net proceeds is equals to 10 lakhs. Same issued at par. So KD is equals to I into 1 minus T upon NP. Interest is 1,20,000 into 1 minus tax rate is how much? 30%, 0.3 upon 10 lakhs into 100. Eight point 4%. 8.4%. Please write. Second, they are saying at 20% premium. At 20% premium, net proceeds will change. Net proceeds is equals to 10 lakhs plus 20% will be how much? 12 lakhs. 12 lakhs. Solve it. AD is equals to, interest will be same, 1,20,000 into 1 minus 0.3 divided by 12 lakhs into 100. How much? 7. Okay, 7%. Third, I hope everybody is understanding what we are doing. At 10% discount, they are saying 10% discount means nominal value was 10 lakh. 10% discount means minus 10%. 10% of 10 lakh will be 1 lakh. So it will be issued at what? 9 lakhs. So net proceeds will be 10 lakhs minus 10% of 10 lakhs is equals to 9 lakhs. So KD is equals to 1,20,000 into 1 minus 0.3 divided by 9 lakhs into 100. How much? 9.3. 9.3%. Easy. Done. Okay. Next. Question number 36. I am reading out. Listen. Nominal value of debt debenture issued is rupees 10 lakhs. So nominal value is equals to 10 lakhs. Okay. So the debentures are issued at 10% discount. That means net proceeds will be 10 lakhs minus 10% will be how much? 9 lakhs. Same way. Carry a interest of 12%. That means interest is equals to, interest is calculated on what? Not the net proceeds, on nominal value, face value. 10 lakhs multiplied by 12% will be how much? Rupees 1,20,000. The total duration N is given. N is equals to how much? 10 years. This time debt is what? Redeemable or irredeemable? Redeemable. So you have to apply the KD formula. Okay, KD formula. I missed one point. Sorry, I missed one point. Right. Mark here and write. Mark here and write. Sometime in exam, they don't ask KD, they say YTM. They say this as YTM. Please write YTM. Please mark this and write YTM. Yield to maturity. Do you remember? If you yield means what? Return. If you hold the bond till the maturity, what is going to earn? That is the yield. Yield to maturity. YTM. Yield to maturity. If you hold the bond till the maturity, the return earned by the investor is YTM. Yield to maturity. Okay, coming back. N is 10 years. Next, tax rate is 30%. T is equals to 0.3. So let's calculate KD. This time the formula is what? I into 1 minus T. Interest will be my income. plus as an investor redemption value minus net proceeds upon I missed one point, but are redeemable at par. So here you should write redeemable at par means what? 10 lakhs redeemable at par upon n upon RV plus NP upon 2. RV plus NP upon 2. Interest is, please apply the formula, 1,20,000 into 1 minus 0.3 plus redemption value is 10 lakhs minus NP is 9 lakhs divided by net proceeds, life is how much? 10 years divided by average of 10 lakhs plus 9 lakhs upon 2. Answers 12 into 0.7 will be 84,000 plus 10,000. Average will be 9,50,000 into 100 you should do to get in percentage into 100. Okay, please do into 100. How much? 9.89%. 9.89%. Please copy. Easy. Chapter is very easy. Okay. Done. Okay. Please complete. Because two are very extreme values. When you calculate anything, that should be on average. Means your investment is not 9 lakhs. That can be done. But 9 lakhs plus 10 lakhs, you should take the average in the base. Okay, because it is always, remember, in ratios, these are what? These are your investment balance sheet items. Balance sheet items should be taken at average because they are standing at one extreme point anywhere in calculation. Okay, anywhere. If those are the extreme values, now you should always take the average. Copy this. Question number 37. 12% debenture of rupees 10 lakhs. Okay, issued at par. Tax rate is how much? 40%. Life is not given. So therefore, which formula? Irredeemable debt. %12 debentures 10 lakhs means interest will be KD. First part, KD is equals to interest into 1 minus T upon net proceeds. Interest will be 1,20,000. 1 minus T, tax rate is how much? 30%. Divided by 10 lakhs issued at par into 100. 8.4%. Number 2. 12% debenture. How much? 7.2. Yeah, 7.4 na? 7.2. Okay, tax rate is 40%. Okay. I missed out. What I am saying? Sorry, it is 40%. This 1,20,000 is correct. 10 lakh is also correct, right? So 40%. So that means 6 sevens are 72. Correct, na? How much? 7.2%. Okay. %7.2%. Next. Debt is how much? 12%. Issued at 20% premium. Means 10 lakh plus 20% will be 12 lakhs. So KD is equals to, I am not writing the formula this time. Interest is 1,20,000. Tax rate is 50%. So minus 0.5 divided by 12 lakhs into 100. 5%. Third one, 12% debenture issued at discount, 10% discount, tax rate is 50%, same formula. KD is equals to 1,20,000, tax rate is 50%, 0.5. Issued at 10% discount means 9 lakhs into 100. 6.66%. 67 I will write, 6.66 recurring, 67. 12% debenture of rupees 10 lakhs issued at 5% discount. Underwriting commission thereon is 80,000. Okay, underwriting commission is there. So understand. So 5% discount. So net proceeds is equals to 10 lakhs minus 5% of 10 lakhs, right? And then minus 80,000. That also will come minus 80,000 because underwriting means it's a flotation cost. Okay. So minus 80,000. It will decrease your net proceeds. Company will get lesser money because expenses are there. The debentures are redeemable at par after 10 years from the date of the issue. Tax rate is 40%. This time life is given. Okay, net proceeds is how much? 10 lakhs minus 50,000, correct? And minus 80,000. How much? 8 lakhs 70,000. Rupees 8 lakhs 70,000. KD is equals to, I'll write the formula, I into 1 minus T plus RV minus NP upon N, the whole divided by RV plus NP upon 2. In CapBudge also, if you remember, there was something called as average rate of return. What we used to do? We used to take the average of the investment because extreme values. Interest is how much? 12% will be 1,20,000. Tax rate is 40%. So 1 minus 0.4. Redemption value redeemable at par. So 10 lakhs. Minus net proceeds is 8 lakh 70,000. Divided by life is 10 years upon 10 lakhs plus 8 lakh 70,000 upon 2. 72,000 plus 13,000, correct? Divided by average is how much? 9 lakh 35,000 into 100. Final answer 9.09%. 9.09%. Please write. Have you everybody understood how to treat underwriting commission? You have to deduct it from what? Net proceeds. Fifth part. 12% debenture interest issued at 5% discount. Underwriting commission is 80,000. Again, net proceeds will be how much? 8 lakh 70,000. Same what we did above. Right? Redeemable at 20% premium. So redemption value is equals to 10 lakhs plus 20% will be how much? 12 lakhs. 12 lakhs, na? So KD is equals to interest is 1,20,000 into 1 minus T. Tax is how much? 40% plus redemption is 12 lakhs plus issue is 8 lakh 70,000 minus will come. Life is 10 years divided by 12 lakhs plus 8,70,000 average of redemption and net proceeds is equals to how much? 72,000, correct, minus 33,000 plus 33,000, sorry, plus 33 upon average 35, 10,35,000 into 100. Answer is how much? 144%, 10.144%. Okay. Done. New thing what is introduced. Please completed. Shall we proceed? Right, cost of debt. Cost of debt. Cost of debt using PV method. Using PV method. In bracket right. YTM approach. In bracket right. YTM approach. Or IRR method. Or IRR method. Or IRR method. Come to, listen, come to question number 52. I think page number is 259. Question number 52, page number 259. IDB, zero interest deep discount bond, face value of rupees 1 lakh, each issued at 2,500. Please understand, zero interest deep discount bond. We have done with sources of finance. What is zero interest deep discount bond? What? The bond is issued at deeply discounted. There is no interest. The difference of this amount means I am issuing at 2,500, will be redeeming at 1 lakh rupees. The difference you will earn, whatever is the difference, is payable in how many years? 25 years. That is your earnings. No interest will be paid. That is called what? Deep discount bond. Okay. Generally for deep discount bond, the tenure is longer. For zero coupon bond, similar, but the tenure is shorter. That's it. Compute the cost of debt. Alternatively, they are used in a language zero coupon bond or zero interest deep discount bond or zero deep discount bond, anything. Compute the cost of debt if there is no corporate tax. Okay, so YTM or IRR method will be used. Okay, how to calculate? Listen, guesswork. IRR means guesswork, right? Trial and error. So this is not a sum of annuity. Please understand. Question number is 52. This is not a sum of annuity. Okay. So what we will do? Listen. Future value is equals to present value into 1 plus I raised to n. Correct? Okay. So this is the formula to be used. Okay. So I want you to think how to solve the sum. Think on this. How you will solve. So Someone is saying that it is between 15 and 16%. How you will calculate? Please tell me. Error, trial and error method. How you will calculate? 1 lakh is the face value, correct? Present value was how much? 2500. Right now? Into 1 plus I raised to 25. Correct? So what I will do? I will take this 2500 on the other side. I will get what? 40. Correct? Is equals to 1 plus I raised to 25. Right?
Yes, sir.
Correct? So trial and error method. I will apply I is equals to 15%. Check 15%. How much it is? For 15%, how much is 1.15 raised to 25? Check 1.15 raised to 25. How much it is?
Sir, 32.9.
How much?
32.9.
32.919. Correct? Right?
Yes, sir.
32.919. Right? And let's say next rate what you said 16%. Okay. Listen. Minus 40. This is, let's say, my PVCI. Minus 40 is my outflow. Let's say like that. Okay, PVCO. So what is my NPV? NPV is how much? Please check difference.
7.1.
7 point.
One.
Exact. No, it will not be 1. Na, exact. Give me the figures now.
7.08.
08.
7.01.
081. Okay, 7.081 is the NPV. Let us check at I is equals to 16%. This is negative, huh? Negative. Let's check. Let's check at what? 16%. So 1.16 raised to 25. How much is the answer? Check.
40.8.
40.874. 40.874. Oh, it is exact. So minus 40 will give me NPV or what? 0.874 is my NPV. Correct? This is NPV at what? Lower discounting rate. This is NPV at what? Higher discounting rate. Correct? Lower discounting rate, higher discounting rate. So IRR is equals to lower discounting rate plus NPV at lower discounting rate upon NPV at lower discounting rate minus NPV at higher discounting rate. Correct? Into what was the formula? Higher discounting rate minus lower discounting rate. What is the lower discounting rate? 15 plus what was my NPV? Minus 7.081. I'll put this in bracket upon minus 7.081. Okay, and in the formula it was minus. Remember, it is 0.874 multiplied by 16 minus 15. Okay, please try to calculate this. Please try to calculate this. This minus minus will become plus, and above also it is minus. So minus minus will become what? Cancelled. Correct, na? Am I right? 15.89%. 15.89%. Correct? 15.89%, between 15. Please copy this. Please copy this solution. Please copy this. Anybody has the module handy? Do you have the module?
Sir, I have the soft copy.
Oh no. Please check this after the class. Check the answer after the class. Which under root method?
Plus I then under I divide. I mean 40 under I plus I. That method we time value. Then under root times 10 minus 10 plus 1.
Acha, that one. Okay. Understood. Acha, shortcut. That also can be applied. It's a good one. What he's saying is that one can also be applied. Which you have to find the I. So 1 lakh divided by that should be 40. Okay, 40 ka 25th root. That is the easiest method, I think. Right now. But it will give you approx. But the particularly as the YTM.
15.9%.
Yeah, 15.9. Okay. And here we are getting 15.89. So that's very, but that can't be applied. Why? It is shortcut, but you can't apply because they have particularly asked you to apply what? YTM approach. IRR. Right. YTM using PV. Okay. Great. That means answer is same. Okay. Right. Write the heading. Okay. Great. Institute also has given the same answer. Listen. Write calculation. Write the heading. Calculation of present value of fully amortizing bond. Calculate present value of fully amortizing bond. So here what happens? See, ultimately, please understand the valuation. This is called valuation, and we have a full-fledged chapter in CA final. Okay, valuation of securities. So they have put it from there. Okay. Now listen carefully what I am saying. How we value a thing, whatever is the cash flow is generated in the future, we pull it to the present value. And that is the price. That is the price I am saying. Actually, it is not the price. Price is what? Determined by market and demand and supply. Okay. Price is what is going on outside. What we calculate is called what? Intrinsic value. Okay. But casually, loosely they use the word, that is market price. Calculate the market price. That's okay. Means you are stating that whatever you are calculating is the market price in the market. Okay. That's okay. Have you understood what I said? Okay. What we calculate, actually it should be called what? Intrinsic value. Okay. So how we calculate the intrinsic value of anything, any business, anything, whatever is the future value of the cash flows are there, whatever the future cash flows are there, pull it to the present at appropriate discounting rate, appropriate your required rate, appropriate opportunity cost. When you pull it, whatever the present value you get is the value according to you. Okay. So fully amortizing bond, what will happen is, let's say there is a 5,000 bond and in 5 years equally I am going to amortize. So please understand, to the investors, what will be my outflow? One is interest. Correct? One is interest. Second one is the 1,000 rupees. That is what I will pay at the end of the first year. Do you agree? 5,000 bond is there, spread across 5 years. Amortizing means every year I will redeem 1,000 rupees bond. Okay. So first year I will pay the interest plus 1,000. So that is the cash flow. Second year, interest on what? Interest will not be same. Interest on the remaining amount. Out of 5,000, I have already paid 1,000. So remaining is how much? 4,000. 4,000. On that 4,000, I will pay the interest plus 1,000. That will be the cash outflow. Cash outflow for the company, cash inflow for the investor. Third year also, interest on the remaining bond and plus 1,000. Likewise, I will calculate all the cash flows. I will pull it at the reinvestment rate or the opportunity cost or required rate of return. I will pull it, not at the coupon rate. Please remember. I will pull it, and then what I get is present value of the bond. Okay. Come to question number 53. Question number 53. RBML, I am reading it out. RBML is proposing to sell a 5-year bond of 5,000. See, the face value is 5,000 at 8% interest rate per annum. Every year 8%. The bond amount will be amortized equally over its life. Means 1,000 every year. Is that clear? Correct. So if I want to make a table, I will write like this: 0, 1, 2, 3, 4, 5. Initially, at the issue, the bond's value is 5,000. At the first year end, how much is outstanding? 4,000. Yes or no? 4,000 or 5,000? At the year end, 4,000. But listen, to make the calculation easy, okay, because I want to calculate interest for first year. See, understand, outstanding balance I can say at the end of first year is 5,000 for the interest calculation. You understand? For interest calculation, interest is how much? 8%. Please understand. So interest amount is how much? First year, how much interest you will pay? 400. Okay. In the second year, for interest, how much is left? 4,000. On that 8%, because 1,000 is gone out. Correct? Is that clear? So this will be how much? 320. Then 3,000 into 8% is how much? 240. 2,000 into 8% is how much? 160. 1,000 into 8% is how much? 80. Correct? Principal repaid, please understand. Principal repaid. I will repay how much principal? Principal repaid every year is how much? 1,000, 1,000, 1,000, 1,000, 1,000. Yes or no? So total cash outflow. So total cash outflow for the company is how much? They are saying investor. So I will write here cash inflow. They are saying investor. Present value for an investor. So I will write cash inflow. So 1,400 I will get as an investor. 400 interest plus 1,000. 1,320. 1,240. 1,160. 1,080. Agree? I am reading it out. Calculate the present value of the for an investor if he expects minimum rate of return 6%. What is this 6%? Discounting rate. What is this 6%? Discounting rate. So I will write calculation of present value of bond. Calculation of present value of bond. How we calculate present value? Pull all the future cash flows to the present at the given discount rate. Year 1, 2, 3, 4, 5. Cash flow is how much? 1,400, 1,320, 1,240, 1,160, 1,080. Discounting factor at the rate 6%. Present value. Take the total. This is the value of the bond. Understood? Easy. Correct? Here write the heading. Calculation of interest and cash inflow. Calculation of interest and cash inflow. Please copy. Please copy. Yes. Yeah, it will become 0, na? At the end of the 5th year. Means for 5th year, the outstanding balance for the whole year is 1,000. If you want to be specific, outstanding balance at beginning you can write here. At beginning. So 5th year beginning it is out 1,000. Means for 5th year I am using that 1,000. At the end of 5th year 0, na? Yeah, company is paying, na? But question is asked from the investor's point of view. Company, for company it is outflow. For investor it is what? Inflow. I don't know. Answer is what? 5-2? Final answer. Okay, let us cross verify. Done. Copied. Please give me the factors now. 6%.
0.9.
0.9433. 8888.
8899.
8899.
0.8.
0.8396.
0.79.
7920.
742. 7472.
7472. And the final answer is 5,262. 5,000 approx. 5,262. Okay, this is the present value. Okay. Done. Therefore, present value of bond is rupees 5,262. 5,262. Okay. Next, write the heading. Calculation of present value of don't write present value, write calculation of KD for convertible debts. Calculation of KD for convertible debts. Done. Convertible debt means what? It will be converted into what? Shares after a certain period of years. That is called convertible debt. How to calculate that? Okay. Please come to question number 54. Company issued 10,000 15% convertible debentures of rupees 100 each with a maturity period of 5 years. Okay, that means for 5 years it has been issued. At maturity, the debenture holders will have the option to convert the debenture into equity shares. The company in the ratio of 1:10 means what? For 10 debentures, you will get what? 1 share. Right now? Or ulta? 10 shares. For 10 shares, you will get? Yeah, for each debenture. Because understand, shares face value is less, that is 10. Is that clear? Nobody will take. If you, for 10 debentures, if you give 1 share. Okay, for 10 shares, you will get what? For 10 shares, you will get for 1 debenture. For 1 debenture, you will get 10 shares. Okay. The current market price of each equity share is 12. And historically, the growth rate of the share is 5% per annum. Historically, the growth rate is how much? 5% per annum. What does this mean? Current price is 12. But after 5 years, what will be the price? Can anybody tell me? Correct. 12 into 1.05 is the growth. Okay. 0.5 is the growth. For how many years? For 5 years. Understood? So that will give you what? That will give you the value of equity. Correct. Listen carefully. Whether you will convert or not, it's an option. See, they have given the option to convert. It's not compulsory. So if the shareholders' value is increasing, then only they will convert. Okay. So according to till this point, what I have read, according to that, let us read it. Calculate the cost of debenture assuming 35% what? Tax rate. Listen carefully what I am saying. This debentures cash value is how much? Debentures cash value is rupees 100. Face value is how much? 100. Means when it will get redeemed, how much you will get? 100. Did they say anything else? No. value of share, understand, value of share. Currently it is how much? 12. Every year, historically, it has grown by how much? 5%. So if it grows by 5% for 5 years, what I am calculating? This is which formula? Future value. Single cash flow future value. 12% growth of 5% for 5 years. Correct? How much it is? You know how to do it. 1.05 into equals to 4 times, equals to 4 times, multiplied by 12. How much? 15 or 153? Acha, 15 point. Correct. 15 point. 15.31553. Okay. Multiplied by, this is value of 1 share. 10 shares you will get. So the value is how much? Rupees 153.153. Understood? Correct. Higher is which one? This one. So whether they will execute the option or not? Yes. Are you understanding? Okay. This option is also called what? This option is also called what? Anyone? Sources of finance. From sources of finance. This option is called what? Option to convert into shares is called what? Warrant. What it is called? Warrant. Okay. So this is the value. So higher is what? So the conversion option will be executed. They are asking us what? KD. Okay. So in by two formulas, by two methods we can calculate. Okay. By two methods we can calculate. Please copy this much first. Copy this. Done. Right. Shareholders, debenture holders, debenture holders, debenture holders will opt for conversion, because the value of share is attractive. The value of share is attractive. Okay. Method 1, listen. Method 1, I can use formula, KD formula. What is KD formula? I into 1 minus T plus RV minus NP upon N divided by RV plus NP upon 2. Correct? So what happened? 15. 1 minus tax rate is how much? 35% plus redemption value. Understand, when it will get converted, how much I am going to get? What value I am going to get? 153.153. 153.15 I will get. The value of share, that is my redemption value. Minus net proceeds is 100. How much is the life? 5 years. Correct? 5. So divided by, yes, 153.15 plus 100 divided by 2. Please calculate. Please copy and calculate. Method 1. This is 9.75 plus 53.15 divided by, please give me figure for this now. 153.15 minus 100 divided by 5. 10.62. 63. Okay, denominator. Okay, into 100. Answer is 16.10. This is percentage. You should write in the bracket approx. What you should write? Approx. Because this formula does not consider what? Time value of money. So it is approx. Nearby answer. Okay. Done. Method 2. Method 2. Method 2. What? Using PV method. Using PV method means IRR. Using PV method. I will not take table. Instead, means I will make a table, but instead year by year, what I will do is I will use 1-5 because interest payment is same, na? Have you understood? 1 to 5 interest is same and 5. So cash flow is how much? Tell me interest net of tax. Here we have calculated 9.75. 15 into 1 minus 0.35 is 9.75. And at the end, what is the redemption value? 153.15. 153.15. Correct? Okay. Let us discount that. Discounting factor. Let's take 15%. Because above I know na 16. So I am taking 15. Okay. 16 is approx. So let's take 15. Calculate the present value. Discounting factor at the rate 16%. PV. I hope everybody remember how to do. 1.15 divide. Yeah, divide equals to 5 times. 1.15 divide equal 1, 2, 3, 4, 5. Basics. Whatever figure you get, you should write it here. Then press GT. That figure you should write it here. GT figure should be here. Whatever you get here should be written here. After pressing the equals to. Right? Three point 3521. Okay, 0.4971. Okay, this is PVCI. What will be the PV outflow? Outflow will be 100. Today's value paid. This will be your NPV. Complete the sum. If you have done, please let me know the figures, okay? Uh, 32.68. Acha, this one NPV. Acha, PV, okay. 32.68 above. 32.68, okay. 76.13 total. 81. So 8.81 is NPV, okay. Discounting factor for 16. 3.2742. 4761. 3.2742 multiplied by cash flow. Remember, in exam, don't make a mistake. How much? 31.92. 153.15 multiplied by 0.4761. How much? 72.91. Total? 104 at 16%. Okay, 104.83. So 4.83. So this is also positive. Okay, we should have taken more. Okay, 17-18%. Fine. Let's calculate IRR. Lower discounting rate is 15 plus 8.81 upon 8.81 minus 4.83 multiplied by 16 minus 15.
.21.
17.21%. 17.21. See, there it was 16 point something. Here we are getting 17.21. Done. Right dating. Cost of preference share. Cost of preference share. KP. Cost of preference share KP. Two parts. Redeemable, irredeemable. Irredeemable, redeemable. Irredeemable. Please tell me what will be the formula. Think and tell. Instead of interest, here what will be there? Dividend. Dividend upon what? What we call for share, what we pay? Price. Price P0. Correct, P0. This is called what? KP. 1 minus T will not come. Why? Because it is not net of tax. It is not tax deductible. Dividend is deducted. Preference dividend deducted after the tax payment. Right? I hope it is clear. On the same line, KP for redeemable, there it was I into 1 minus T. Here what I should write? Dividend D plus redemption value minus net proceeds or issue price upon N life upon RV plus NP upon 2. There is no rocket science. Okay. I am not going to do any individual sum. We will apply it in the main question only. Same thing. So write cost of equity. Right, cost of equity heading. Cost of equity, that is KE. That is KE. Cost of equity, that is KE. Cost of equity, that is KE. Understand? In debt, whatever we had to pay to the debt holders was fixed. There was a fixed commitment. Correct? In preference also, it is fixed. Your commitment is fixed. What is the commitment towards the debt holder? Interest. For preference shareholders, what is the commitment? Dividend. For equity, there is no commitment. Therefore, the calculation of cost of equity, okay, is a tedious job. It's difficult. Understood? Difficult in the sense in practical life, which approach to be followed and all should be considered. Right? But how you can calculate means the cost of equity. First is dividend price approach. That is dividend upon price. You will get cost of equity. That is the same thing what we did in preference share also. Sometime what happens, the dividend or the EPS or the price grows at a constant rate, means the company is of a growth type. Every year the company is growing. There the formula will change, and there we will apply Gordon's model. It is called constant growth rate model, where the, see, when I am writing a D upon P0, what is written on the screen? That means I am assuming that there is no growth. Every year the dividend will be same. Understood? But some companies, they have the habit, every year the dividend grows. Correct? So there constantly, means every year 5%, 5%, 5% we will grow. Okay, this dividend, this more clarity will come in dividend decision. Okay, last chapter, dividend policy. So some companies, they have the habit. Okay, I am asking you whether the company should pay the dividend or not. Whether the company should pay the dividend or not. It depends. It depends. That we will understand in dividend decision. This dividend now constantly grows. This dividend constantly grows. Grows at what rate? Grows at what rate? That is, that companies knows by the historical means this thing trend. Every year the dividend will grow. So when the company's dividend grows constantly, what we apply? Constant growth rate model. What we call? Constant growth rate model. Okay, or it's Gordon's model. Myron Gordon was the person who gave the formula. Gordon's model it is called. The third one is earning price approach. The third one is what? Earning price approach. What we do is, generally the companies in ratios we will see, we calculate price to earning multiple. P upon E, market price upon earnings. Market price upon earnings. So what we do is, listen carefully, I will give you the all notes. Price upon earnings is what? Price upon earnings is P multiple. What it is? P multiple. Okay. So what I do is, I take the inverse. I take the inverse of this and I say this is P by E is what? Earnings. Earnings for the shareholder upon price. Please understand. Earnings is what? Earnings for the shareholder. EPS. EPS, earning per share. Price is what? What I have invested. So this gives me what? Return for the investor. Return for the investor is what? Cost for the company. KE. Are you understanding? 1 upon P. 1 upon P is what? E upon P. When I take multiplicative inverse, it becomes E upon P. E is what? Earnings for the shareholders per year, per share earnings upon market price investment. So E upon P is what? Returns for the shareholders, and that returns is cost for the company. So this is also one approach. It is what? Earning price approach. The next one is realized yield approach. What it is? Realized yield approach. This also we will discuss. I'm not going into it. And next one is CAPM. Okay. CAPM is what? Capital asset pricing model. Capital asset pricing model means what? Capital asset is priced under this model. Means we are trying to calculate the price of the asset. Okay, that is the shares. So it is called capital asset pricing model. We will discuss it in details. Okay. Right. Before, right, write the heading. Approach 1. Right, dividend price approach. Dividend price approach. K is equals to D upon P in bracket, right, when no growth. When no growth. When no growth means when there is no growth in the company. In the company. In the company. When there is no growth in the company. Let's be specific. Right, approach 2. Approach 2. Dividend price. Dividend price plus growth approach. Dividend price plus growth approach. Dividend price plus growth approach, or constant growth rate model. Constant growth rate model, or constant growth rate model, or what was the name I said? Gordon's is famous. Myron first name is okay. Gordon's model, this is very famous. Gordon's model. K is equals to D1 upon P0 plus G. Right, D1 is what? Dividend at the first year end. P0 is today's price. How you will calculate D1? D0, that is current dividend, multiplied by 1 plus G. Growth, you will give growth. Every year's dividend is different.
So what is
Right here, make an arrow. D1, right. Expected dividend at year end 1. P0 is equals to price at year end 0. That is at year end 0. That is today. G is equals to growth rate. Done. Right. It is assumed under the model. The growth is growth of dividend. The growth of dividend, comma EPS and price. From where you will get the growth? The growth is of the dividend. The growth is of the EPS. When we are calling growth means what? Growth of EPS, growth of dividend, growth of price. Generally it is given in the question. Sometimes indirectly they will give you. Okay, they will not give you the growth directly. They will tell you that constantly it is growing. They will give you two prices. So you will have to check how much is the growth. They will give you dividends, range of dividend. You will have to check what is the growth. Done. Question number 39. Come to question number 39, page number 253. Okay. Consider the following information provided by NJ Limited. Current market price of equity share is 160. So P0 is equals to 160. Current market price means 0th year. P0 is 160. Expected market price at the year end P1 is equals to 184. Means it will be 184. Expected dividend at the year end is 16. Rupees 16. This is what? D0 or D1? D1 16. If D0 is given, you have to add the growth 1 plus G. Okay, you will get D1. That also we will practice. 16. You are required to determine the cost of equity using dividend price plus growth approach. See why the name is like this. Dividend price plus growth approach. Remember with the wordings. The growth is constant, therefore the name is constant growth rate model. It was found by whom? Gordon. So the Gordon model. Okay, hence the name. Listen, they have not mentioned about the growth. They are asking us to apply, but they have not mentioned about the growth. So we'll take growth of what? Growth of price. How I will calculate the growth? See, by price is P1 minus P0 upon P0 into 100. This is the growth. I bought it for 160. It rose up to 184. That is the growth. Okay. Understood? So 184 minus 160 upon 160. into 100. How much is the growth? How much? 15%. 15%. Can I calculate? If I know the G, can I calculate the K? Yes. K is equals to D1 upon P0 plus G. D1 is how much? Expected dividend is 16. P0 is 160 plus growth is how much? 0.15. Remember to take in decimal. Growth should be taken in decimal. Don't take 15 directly. Answer will be wrong. This will be 0.1 plus 0.15 is equals to 0.25, or I can say 25%. Understood? Please copy. Please copy. Done? Shall we proceed? Listen. Listen carefully. Nothing to do with the sum. Okay, listen carefully. Please understand. My P0 was 160. My P1 was 184. And the dividend what I got is 16. Correct? So can I say initially I had 160. At the end of 1 year, I have 200 rupees. Agree? Correct? So my return is equals to 40. Yes or no? Return in percentage will be 40 I got. How much I invested? 60. 160 into 100 is how much? 25% is same as this. Same as this. Cost of equity is what? The return earned by the shareholders. Correct na? Return what is earned by the investors, that is 25. That is whatever is the required rate of return, that you have to give to the shareholders. Correct? One more way. Listen carefully. Can I say my future value is 200, my present value is how much? 160. Correct? So 200 is equals to 160 into 1 plus I raised to 1 years. Yes or no? So 200 divided by 160 is how much? 1.25 is equals to 1 plus I. So I is equals to 0.25. That is what? 25%. Another way to do. Same thing. Understood? Correct? These are not solutions what I am giving. I am showing that finance can be solved in any way. One minute. Listen carefully. P0 is nothing but how I can calculate the present values. As I said, all the future values should be pulled at required rate of return. That means D1 plus P1 is my future cash flow. Agree? D1 is future cash flow standing at first year end. P1 is what I will get after selling, divided by my required return is 1 plus KE. Understood? Correct? 1 plus KE is nothing but D1 plus P1 upon P0. Agree? KE is equals to D1 plus P1. Okay, D1 plus P1 upon P0 minus 1. Correct? Right now? Next, listen carefully. What I said, since G is equals to P1 minus P0 upon P0, growth is what? Growth is what? Rise in the price. Agree? Correct, na? So, can I say, listen, according to this formula, can I say G into P0 is equals to P1 minus P0? Correct? P1 is equals to, please understand, G into P0 plus P0. Agree? I have taken this that side, right now? Correct now? G into P0, Pogo. Okay. Plus what? P0. P0 is common. P0 is what? Common. So can I write P1 is equals to P0 into, I will write 1 plus G. G plus 1, 1 plus G. One and the same. Agree? Listen carefully. Listen carefully. Here, in the first formula, what I wrote. In the first formula, what I wrote. P0 is equals to, listen carefully. P0 into 1 plus, or I will write again. P0 is equals to D1 plus P1 upon 1 plus KE. So P0 into 1 plus KE is equals to what? D1 plus P1. Agree? If I open this, P0 plus P0 into KE is equals to D1 plus P1. Right now? Correct? Can I say that my P1 is nothing but P0 into 1 plus G? P0 plus P0 into KE is equals to D1 plus what I can say? P0 into 1 plus G. Yes or no? Right now? P0 plus P0 into KE is equals to D1 plus, I will open the bracket, P0 plus P0 into G. Right? Are you understanding what I am doing? So if we cancel, can we cancel this? Can we cancel this? Yes or no? Correct. We can cancel. Listen carefully. P0 into KE. If I take this side, minus P0 into G is equals to D1. Correct. Into is equals to D1. P0 is common. So KE minus G is equals to D1. KE minus G is equals to D1 upon P0, and hence K is nothing but D1 upon P0 plus G. Hence proved. Are we derived the formula? Gordon's model. Understood. So what I proved? Growth is nothing but growth in the price. Growth is nothing but growth in the price. Is that clear? Understood. I have used a long cut, but mathematically if you go now, this is what the author has explained. Understood. The Gordon, I have used a long cut, what he has used. There is a shortcut also. Directly in the first formula itself, maths people can understand. There itself I can prove this. Correct. Take the LCM and here only I can substitute. In this step itself, if I take cross multiply P0 into here, P0, then I will take P1 minus P0 upon P0 separate, D1 upon P0 separate. So P1 minus P0, sir, you said G, directly I can apply. But I solved in the way how he has done. Intellectuals, no? You don't understand easy things. Okay? Fine. Do you want to copy this? No? Fine. Which one? You copy this. Come to question number. Okay, before that, below the question number 39. Below question number 39, some important points is given. Please read that. In absence of information, always assume, this is page number what? 253. Page number 253. In absence of information, always assume the dividend will grow at the same rate at which the price share grows. That means growth is same. Okay, if the price at the present is 160 with reference to last sum is expected to be 184, the growth will be how much? 15%. The growth in the dividend will also be 15%. Okay, if the question is silent regarding the approach to be used, determine cost of equity at sufficient data is available, then use the dividend price plus growth approach. If growth is given, they are saying you that constant growth rate will be applicable, then use constant growth rate model. If growth can be calculated, then apply this model. Is that clear? Out of 5 approaches, you will have to check which approach to follow. Okay. Question number 40, just write here. In this earning price approach, write K is equals to 1 upon PE. 1 upon PE. K is equals to 1 upon P. Please write. This is page number 254. Space is given. Is equals to E1 upon P0, to be specific. E1 expected EPS, first year EPS. Okay, last year's price. Note, see note. This approach is used when by the enterprise who acquire the equity share in other enterprise with an intention to establishing a control over such other enterprise, wherein how much the company earns in terms of per share is more relevant as compared to what? Dividend distributed by it, where the earnings is important. Because I want to take over another company, I want to acquire it. So what is important? Not how much the dividend there is to pay. What is more relevant is how much earnings there is to pay, there is to earn. So therefore this earning capitalization approach or price earning approach. Right here, earning capitalization approach. Earning capitalization approach. This is also a name. Earning capitalization approach. Our institute rarely uses, but they may use. Come to question number 40. Very easy question. The market price of each equity share at present is rupees 120. Means P0 is how much? 120. The expected dividend by the year end is how much? Rupees 15. means D1, expected dividend D1. The company has a constant growth of 8% per annum. Constant growth of 8% per annum. Growth is given. And maintains a dividend payout ratio of 50%. Ratio can be clubbed anywhere. Ratio can be clubbed with any chapter. Understood? So dividend payout. Let us understand what is dividend payout. Okay. Before that, let us complete the question. Calculate cost of equity in the terms of percentage using the following approach. Dividend price approach, dividend price plus growth approach, earning price approach. Okay, all the three approaches. Listen. Write the heading dividend payout ratio. Dividend payout ratio. DPR is equals to DPS upon EPS. DPS is equals to dividend per share. Dividend per share. EPS is equals to earnings per share. Earnings per share. What is the interpretation?
Out of
Exactly. Out of the earnings, how much is the dividend paid? If let's say out of 1 rupee, 50 paise is the dividend per share. Earnings is 1 rupee. If I am paying 50%, that means 50% is dividend payout ratio. If 40 paise I am paying, 1 rupee is the EPS. That means 40% is the payout ratio. The remaining will be called what? Retention ratio. Retention ratio. Write that also. Retention ratio is what? Is equals to 1 minus dividend payout ratio. 1 minus dividend payout ratio. If 40% dividend is paid, 60% is retained by the firm. Okay, going back to the question number 40. I will write the parameters, what is given in the sum. P0 is equals to 120. P1 is equals to 15. G is equals to 8%. Okay. Maintains dividend payout DPR is equals to how much? 50%. Okay. And what they are saying? Cost of equity, KE we have to calculate. First approach is what? Dividend price approach. Please write. Please be with me. Solution, first part. Dividend price approach. Listen, in dividend price approach, D0, D1 is equals to D2. That is all equals to what? 15. There is no change. There is no growth. Dividend price approach. So D0, D1, D2, everything is same in dividend price approach. K is equals to D upon P0. D is how much? 15. P0 is how much? 120. Okay, what is the answer?
the first
12.5%. This is the answer. Please copy. Dividend price plus growth approach. Dividend price plus growth approach is what? P is, no, not P0. KE is equals to, tell me the formula. Dividend D1 upon P0 plus G. The expected dividend is how much? 15. D1 is given, remember, upon current price is 120. Growth, how much they said? 8%. 0.08. 0.125 plus 0.08 is equals to 0.205, or I can say 20.5%. 20.5%. Dividend price plus growth approach, K is equals to D1 upon P0 plus G is 20.5%. Next is earning price approach. Listen carefully. Was the earnings given in the question? No, earnings was not given in the question. Earnings is not given. How I will calculate earnings? Dividend payout ratio is equals to DPS upon EPS. Okay. So payout is how much? Payout. They have given the payout. 50% is equals to dividend is how much? 15 upon EPS. Remember this is what? D1. Okay, when I will divide it by 0.5, what I will get? E1, expected dividend. Please understand. Okay, if it is D1, I will get what? E1. So E1 is equals to 15 upon 0.5 is equals to rupees 30 earning per share. This is what? EPS, earning per share. K is equals to E1 upon P0. So E1 is 30, P0 is was how much? 120. Correct? 25%, 0.25 or 25%. Done? See question number 41. Question number 41. Price per share at present. Question number 41. Price per share at present is rupees 125. Declared dividend at present is 12.50. The growth rate is 20%. Calculate cost of equity by dividend price plus growth approach. Okay. So P0 is equals to 125. Dividend declared D0 at present. So D0 is how much? 12.50. Please understand. The growth rate is 20%. G is equals to 20%. You have to find the K. What is the formula? K is equals to solution D1 upon P0 plus G. Is the D1 available?
Okay.
No. So D1 is what? D0 into 1 plus G. Correct. Growth. You should give the growth. So 12.50 into 1.2, 20%, 1.2 multiply. How much is D1? 15. So 15 upon P0 is how much? 125 plus growth is how much? 0.2. Okay, simple. Answer is how much? 0.12 plus 2, that is 0.32, or I can say 32%. Done. 32% done. Those who have done, start with question number 42. Start with question number 42.
So 37 plus 10%.
How much is the answer? Everybody is getting 37.5. Is it 37.5? Please tell me. K is equals to what is D1?
So we have to calculate the growth rate.
Okay, growth we have to calculate. D1 upon P0 plus G. So present P0 is 120. Expected price per year will be 150. Expected price will be 150. Okay, expected price is given. So G we will have to find P1 minus P0 upon P0 into 100. Correct, growth. So P1 is how much? 150 minus 120 upon 120 into 100. Answer is how much? Growth is 25%. So I will write here plus 0.25. D0 is given. Expected dividend to be grow. The dividend at present means D0 is given. So I'll have to also calculate D0, D1. D1 is equals to D0 into 1 plus G. D0, presently it is 12 dividend. 1.25. Answer is how much? D1. 25%. 16. 15. Right, 15. 3. So 15. 15 upon 120 divided by answer. How much you said? 37.5%. I hope everybody has got this. Okay. Great. Right, heading. Write the heading. Realized yield approach. Realized yield approach. Realized yield approach. In bracket write IRR. Similar to IRR. In bracket write IRR. Write some notes on realized yield approach. Right. According to this approach. According to this approach. According to this approach. Average rate of return. Average rate of return realized in past realized in past is regarded as expected return means what? Whatever is the past return that will continue in the future, that is what the assumption is. Okay, right? Assumption number 1. Okay, Please tell me, when the historical returns are same as the expected return, means future returns will also be same. That means risk has increased, risk has decreased, or risk is same. Same. Risk is, right, first assumption. Risk, what, faced by the company. Risk faced by the company is same. Risk faced by the company is same. What is KE? KE is expectation of the shareholders. Okay. KE is expectation of the shareholders. Understood? Required rate of return of the shareholders. What they want, that we should pay. So according to this, average return is same as what? Expected return. Second assumption. Shareholders' expectations are same. Shareholders' expectations are same. Shareholders' expectations are same. Third, reinvestment. The cash flows which you will get now, that can be reinvested. Reinvested at what? Reinvestment rate, opportunity cost. Reinvestment opportunity cost. Reinvestment opportunity cost is equals to realized yield. Is equals to realized yield. Means they are assuming that whatever is your opportunity cost, that you will realize. IRR assumes that reinvestment is done at. IRR assumes the reinvestment is done at. IRR itself, same point. Your opportunity cost is what? Realized yield. Realized yield is what? IRR, capital budgeting. Same thing. Question number. Come to question number 55. See question number 55. Have you got it? Page number is 260. They have solved it in a very weird manner. They have not explained in the module how to solve the sum. But same way like we do for IRR. Mr. Mehra purchased a share of Alpha Limited for rupees 1000. This is what? Inflow or outflow? Outflow. When you purchase, it's an outflow. He received a dividend for 5 years at the rate of 10%. Okay, at the end of the 5th year, the share, he sold the share for Alpha Limited for what? 1128. This is what? Inflow. Dividend is what? Inflow. That 10% should be calculated on what? Let us assume the face value is 1000. Let us assume the face value is 1000 because he has purchased for 1000. Now that is the face value. So 1000 into 10%, dividend is how much? 100. 5 years you will get 100, 100, 100. 5th year you will get 100 plus 1128. You are required to compute the cost of equity as per what? Realized yield approach. As per realized yield approach. Correct? Understood? I have to calculate IRR. That's it. So let's calculate. Isn't this similar to what we did the bond valuation? Same dividend, so same interest. KD can also be applied, but because it is called saying what? Realized yield approach, you will have to follow that table method only. Okay, IRR approach only. Is that clear? Formula you can't apply. By formula also you will get approx answer. Remember, you understood what I said? 100, let us assume that 100 is what? 100 is interest. 1128 is what? Redemption value. Net proceeds is what? 1000. N is what? 5. You can apply. Okay. So question solution. So I think annuity can be used. Okay. Here 1255 cash flow 100 1128. Correct? Yes, 1128. Discounting factor. Let's take 10%. I don't know how much it is. Let's take 10%. Please check at 10%. 3.7904, 10% for 5 years. And 10% for 5 will be single cash flow 0.62. Huh? 7907. Okay. And 6204, right? 6209, I forgot. 6209, okay. ही हो रही है, okay. Get the present values. 379.07, 700.3752, okay. PVCI 4452. So 79.4452 is my NPV. 1000 was my outflow, today's value. How much I should take? Should I take directly 15 or 12? Okay, so 12%, at 12%. Calculate the PV. How much? Is it positive at 12%? Fine, no problem. Tell me the discounting factor. Discounting factor
6047.
6047. Okay, 5674. Multiply 360.47. 0272. So total is 1000.4972. It's very slight, okay. It's just above 12. Minus PVCO is how much? 1000. So 0.4972 NPV. Calculate IRR. Lower discounting rate plus NPV at lower discounting rate upon NPV at higher discounting rate minus NPV at lower discounting rate minus NPV at higher discounting rate into higher discounting rate minus lower discounting rate. Those who have copied the formula, here it will be lower discounting rate. Please be cautious. Lower is 10 plus 79.4452 upon 79.4452 minus 0.4972 into higher discounting rate is 12 minus 10. 12.01%. Approx. This is approx. If you would have taken 15, it would have gone up. Okay. Discounting rate, if the second one, higher discounting rate would have been 15, it would have gone up. Done. What? No. IRR is okay. You can write the conclusion. Realized yield is. You can write the conclusion. Realized yield is equals to 12.01%. 12.01%. Listen. Whenever returns are calculated, now returns, please understand, returns are calculated, means you have invested your money. So always it will grow at what rate? It will not grow at simple interest. It will grow at compounding rate. Agree?
Yes, sir.
Money invested will grow at compounding rate. Please listen carefully what I am saying. So what should be the approach or formula we should use to calculate the average return? If I have given you the return is for the first year 10%, second year 15%, third year 12%, then for 3 years average return I have to calculate. What I should use? Which average? Simple average or which average? Weighted average, which average? We need to listen carefully. Wherever percentage and growth is involved, please listen carefully. There we have to use geometric mean. Geometric mean. Okay. Where the rate per piece rate is constant, we have to use harmonic mean. I am diverting. Okay, but we have done this in foundation. Correct?
Yes, sir.
So harmonic should be applied. When we are finding the rate, piece rate, when that is constant, you have to apply harmonic mean. Mutual fund. You deposit a constant amount, you get the rate, NAV. So in that, when you are calculating the return, it should not be the simple average or the geometric mean, it should be harmonic mean. Mutual fund companies. Just for the knowledge, when there is no pattern in the given data, you can apply simple average. Then when there is no pattern, but if the trend is increasing or decreasing, you should apply weighted average. Understood? Here we are calculating realized yield, means we are calculating the return. What we are calculating? Return. So we should take geometric mean. What we should take? Geometric mean. Individual years return I will calculate, and then I will calculate geometric mean. Okay. So listen carefully. How we calculate the geometric mean? Let us understand. See, geometric mean is equals to, then you can write, listen, geometric mean is equals to 1 plus first year's return multiplied by 1 plus second year's return. Why I am adding 1? Compounding. Plus, like this you will go, means every year's return should be there till 1 plus Rn, means nth year. Then what you should do? You should take, because you have multiplied, you should take that much root, that is nth root. If the data is for 3 years, 3 years return is given, you should take cube root. If the 4 years return you have, you should take fourth root. And that one was initially which was added, one which was initially added should be deducted. This is how geometric mean is calculated. Is it clear? Understood? How I calculate the return? Please understand, return is nothing but P1 minus P0 plus dividend upon P0 into 100. When I say P1 minus P0, it is capital gain. How much I gained from the price? T is what? Income. So capital gain plus income is what? Return. Divided by investment P0 into 100 will give me return in percentage. Is that clear? Okay, please copy this. Done. Question number 56. Calculate the cost of
Sir,
equity.
1 minute.
What happened? This is 1 plus Rn. 1 plus Rn. Return to the nth year. Return of the nth year. Calculate the cost of equity from the following data using realized yield approach. Please understand, year is given, dividend per share is given. This is first year's dividend. This is second year's dividend. What they are saying, price per share at the beginning of the first year, the price is how much? Beginning of the first year means end of the 0th year, beginning of the second year, dividend is given at the end and price is given at the beginning. Understood? So please tell me, listen. Here I will write from 0, 1, 2, 3, 4. Please tell me the price. Price at the 0th year, end of the 0th year, that is beginning of the first year. How much? 9. Correct? 9.75, 11.50, 11 and 10.60. Is it clear? Understood? Dividend. Listen carefully. Dividend is not given, means for the 0th year it is not given, it is at the end. So I will write here dash. In the first one it will be dash. Okay. Next year it will be 1. Again 1. Again third year end 1.20. Again fourth year 1.25. Fifth year is irrelevant because fifth year price is not given. Have you understood this? Actually the presentation is not correct. Understood? For one thing they are saying beginning and for one thing it is at the year end. Done? Clear? Everybody comfortable now? Okay, so listen, what I will do is, I will take the total of price plus dividend. Price plus dividend is how much? Please tell me. 9. Next is 10.75. Next is 12.50. 12.20. 11.85. Agree? Are you understood? See, listen carefully. I have to calculate the geometric mean. So what I can do is, listen, what people will do, first they will calculate the return. How they will calculate the return? For first year, the return will be 10.75. That is P1 plus D. P1 plus D. P1 plus D. This is already added. That is 10.75. Correct? Understood? Are you understanding? And then divide by P0. This is your P0. Previous year price, that is 9. That is what? 9. Minus 9. P0. This is what? P1 plus dividend. P1 plus dividend. Okay. P1 plus dividend is 10.75 minus 9 upon 9 into 100. How much is the return? Tell me. 19.44%. Understood? Now when I go to the geometric mean here, I have to do what? I have to do 1 plus R1. R1 means decimal. 0.19 means how much I will take? 1.1944. Correct? Instead of doing all these things, means all this minus and all, I can get 1.919 directly. Check this. This is how much? Have you understood this, everyone? 1.19, correct now? So what I will do is directly P1 upon D, I will divide it by what? Upon P0. P0 means previous year price. P0 is what? Previous year price. Directly, why to calculate the return, then take it in decimal, then add 1? Are you understanding? Is there any doubt? Sure, everyone. I'm asking. Clear now? Same way, listen. 12.50 here for second year. 12.50 is what? P1 plus D upon P0. P0 will be what? 10.75. 10.75. Answer is how much? Previous year price, no? It has grown. How much? Yeah, 9.75. Sorry. 9.75. Sorry. Yes. Price. How much? 1.28. Correct. 9.7. P0. So this becomes my P0 new. Understood? So next 12.20 divided by 11.50. Correct? 11.50. How much it is? 0609. Have you understood what we have to do? 0608, whatever it is, 09. Is that clear? So ultimately what I am doing, P1 upon D, P1 plus D upon P0. So ultimately what I get the factors for geometric mean. So please copy this. Right here, this is P1 plus D, P1 plus D. Done. Calculation of growth factor. Calculation of growth factor. Here 1, 2, 3, 4. P1 plus D upon P0. So it is, first one is 9.75 upon 9. Then next one is 10.75 upon 10.75 upon 11.50. Correct na? No, 9.75. 9.75. I made a mistake. Wait. Here it will be 10.75. 10.75 divided by 9. Divided by 9. Then next is this one. 12.50 divided by 9.75. For this will be the previous year will be the base. Next 12.20 upon 11.50. 11.85 upon 11 is the base. Please give me the answer. First one was 1.19, na? 194. 3 decimals you are taking. 44. Okay, 1.2820. 1 point. Next
1.08.
08. Here 1 point 0772. So these are the growth factors. Geometric mean is equals to 1.1944 multiplied by 1.2820 multiplied by 1.0608 multiplied by 1.0772 raised to 1 by 4, fourth root minus 1. For fourth root, 2 times square root you have to press. Yes, if it is fifth root also, we know how to do calculate, correct? Yes or no? Please copy.
So 15.0.
15.01% means it is approximately 15%. 15.01%. Done? Is it completed? Okay, let's proceed. Listen, write the heading. Cost of retained earning. Cost of retained earnings. Cost of retained earnings. CAPM is left. Capital asset pricing model is left in cost of equity. I'll come to that. Okay. So KR, generally cost of retained earning is what? You tell me these earnings which is available with the company, okay, that is distributed to the shareholders, correct? Now actually whose money it is? Whatever is retained by the company, whose money it is? Shareholders. So it should be distributed in form of what? It should be distributed in form of dividend, yes or no? So is there any cost for such retained earnings? Is there any cost? In real sense, no, there is no cost because it's free. But if we consider opportunity cost, if you would have distributed it to the shareholders, they would have invested it somewhere. Are you understanding? If you would have distributed this, in actual sense, real cash flow is not there. It's the retained one. We are not raising it from someone. We are not taking it from someone. In actual sense, no cost. But if you consider, because we are doing finance, economics, opportunity cost is there. If you would have distributed this to the shareholders, then they would have invested it somewhere else. It is whose money? Their money. So there is opportunity cost. There is what? Opportunity cost. Is it clear? Correct. Understood? Good morning. Yeah, shareholders would have invested somewhere, no? So there is an opportunity cost, right? Agree or not? Sure, no? From your tone, I don't feel you people are satisfied. Okay. So therefore, KR is equals to nothing but cost of retained earnings is nothing but cost of equity. Cost of what? Equity. Is it clear? So there is no particularly any particular cost for retained earnings, but whatever is the required return of the what is required by equity, their opportunity cost, what is required rate by equity shareholders, their opportunity cost. So that is K, and K is nothing but KR is nothing but equals to K. Okay, have you understood what I said? I repeat, equity shareholders, they have required rate of return. What is required rate of return? Their opportunity cost. Okay, so that is cost for the company, because there is no commitment like debt and all. So whatever is the expectations of the equity shareholders, you will have to fulfill. Okay, understood? So whatever is their expectations become for cost for the company. K, retained earning, actually there is no outflow, but whose money it is? Actual sense, it is equity shareholders money which the company has retained. So if you would have distributed it to the shareholders, they would have invested at their opportunity cost. So therefore cost of retained earning is nothing but K is equals to K. Have you written this?
Yes.
KR is equals to K. Have you written this? Write one more note. Write note. Yes, please write a note. If personal tax is given, if personal tax is given, if personal tax is given, then KR is equals to KE into 1 minus TP, personal tax. TP means what? TP is personal tax. Okay, whatever is the opportunity cost, okay, whatever is retained, on that personal tax will be applied for the equity shareholders. So K into 1 minus TP, that is personal tax. Personal tax for the person base, income tax, personal income tax, not corporate tax, individual's tax. Okay, self note, sometimes KE and KR may be given in the sum, may be given in the sum. Use the same, use the same. Now there don't apply. Sir said that K is equals to KR. If they have given you the cost of retained earning, use that in the calculation. If nothing is mentioned, K is equals to KR. Is it clear? Okay. So in between, I jump to KE, KR. Let us do CAPM, Capital Asset Pricing Model. Please write Capital Asset Pricing Model. Capital Asset Pricing Model. Capital Asset Pricing Model. We won't pay. K is equals to, what is the formula? RF plus beta into RM minus RF. Listen carefully, then you can copy. Risk is measured in standard deviation. Please understand, risk is measured in standard deviation. Risk are of two types. Risk can be segregated in two types. One is systematic risk, another one is unsystematic risk. One is what? Systematic risk, which is there in the system, non-diversifiable. Those factors which affects every industry. Inflation, systematic, will affect everyone. Okay. Recession, systematic, will affect everyone. So beta means risk can be made into two parts. One is what? Systematic. This is non-diversifiable. Non-diversifiable. You can't diversify it. It will be there. Non-diversifiable. Unsystematic. which is related to the particular your company, your management is bad, you can correct it, diversifiable, you can diversify. The second part is diversifiable, unsystematic. Okay, so systematic will be there, it is there in the system. The factors those affect everyone, each and everyone is affected by these factors, that risk. And unsystematic, which is the risk, those are not from for the whole, it is for you. It may be because your product is not doing good, your quality is not good, that is unsystematic, you need to improve the product quality, that is a risk for your business. So systematic, unsystematic. This unsystematic risk is measured by what? Beta. This systematic risk is measured by what? Beta. Total risk is measured by what? Standard deviation. Okay. What is beta? What is beta? Please understand. Beta is between the stock and the market. Beta is between the stock and the market. Just for your knowledge. Okay, if let's say if beta is 1.5, what does this mean? If the stock okay goes up, sorry, if the market goes up by 10%, if the market goes up by 10%, 10 into 1.5, beta is of a stock, so 10 into 1.5, the stock will go up by 15%. Understood? If beta is less than 1, that is 0.8, if the stock goes up by 10%, sorry, market goes up by 10%, stock will go up by 8%, 10 into 0.8. Are you understanding? Same way for decrease. If this is the beta 1.5, market falls by 10%, stock will fall by 15%. Okay. When beta is greater than 1, for the stock whose beta is greater than 1 is called aggressive stock. Is called what? Aggressive stock. When beta is less than 1, it is called what? Defensive stock. Pharmaceuticals and all. Defensive stock. Okay. RF is what? Risk-free rate. RF is what? Risk-free rate. Risk-free means what? Which you can earn. We have already done this. Please say what is risk-free rate? Which can be earned on what? Government bond. Risk-free. Treasury bill. Have we done this? Which is certain. Correct. Capital budgeting. Risk analysis. When the cash flows are certain, you discount it at what? Risk-free rate. Why? Because you are certain there is no risk. Government bond, there is no risk. Government will pay you. That the return what is earned on government bond is what? Risk-free rate. The return which is earned on T-bill is what? Risk-free rate. RM is market return. RM is what? Market return. RM is what? Market return. What you are going to earn in the market. So what the formula says, you know, a person, please understand. Okay, RM minus RF in between, RM minus RF will be called as market risk premium. What we will call? Market risk premium. Means, let's say I am earning in the market 15% and risk free is 5. That means 10% is premium. Why am I earning extra 10%? Because I took the position in the market. 10% is what? Risk premium. Market risk premium. Is that clear? Understood? How much I will earn in a stock when this premium is multiplied by the respective beta of the stock. This risk premium in market I am earning 10. My stock's beta is 1.5. That means I should earn 15%. This is 15% because of market. But what I want risk free also. So I will add 5. So my total return becomes 12%. Please understand, my total return becomes 12%. Hence the formula is what? K is equals to, I want to earn RF plus beta into RM minus RF. Is it clear? Understood? Please understand again. RM is what? Market return. RM minus RF is what? Risk premium. That much I can earn in the market. When I say market, Actually, what is expected when I say market return, it is expected that you should take the all the investments in the universe practically. Real estate, gold, metal, everything should be taken. That is not possible. Stock, bond, traditional investment, everything, alternative, everything should be taken. All these investments, but practically that return is not available in the market. Then, sir, what we do when we have to calculate KE and we want RM, we use the Nifty returns.
So bench.
We use the Nifty returns. Nifty, you can say benchmark. It's not benchmark. Benchmark is something different. That is the market return. Means what? Array, it is replica. Nifty is what? Replica of the market. So we use Nifty returns. I hope everybody knows what is Nifty. Why it is called Nifty? National 50 stocks. National 50 stocks. So therefore Nifty. Now there are 51 stocks. Okay, in that. Okay. So RM minus RF into what? Beta means that much. Beta is of what? Of a particular company's stock. So this is market return, but I will earn how much? Multiplied by beta and plus risk free. So I have to earn because I'm taking a risk. I'm taking a risk. RF plus beta. This is what? Risk premium. Beta, you should write beta into RM minus RF is what? Company specific risk premium. Company specific risk premium. Again I am saying K is what? Required rate of return of whom? Investor. That becomes cost for the company. How much the investor expects? RM minus RF, market risk premium, multiplied by beta, this much extra I will earn because I am investing in the stock of a particular company. That is called beta into RM minus RF is what? Company specific risk premium. And plus I have to earn RF because RF is basic. Without risk I can earn this much. So that should be there in the calculation. Understood? Please copy. Copy from here. Done. This, not this. Listen carefully. Yes. Systematic means which is there in the system. Which is there in the system. Means see, when the GDP growth is not there, will it affect particular industry or it will affect everyone? Recession in the economy. Everyone. Can you avoid it? Can you avoid it? No. It is systematic. It is systematic. It will be there. If inflation is high, who is affected? Only you or everyone? Everyone. Can you change that? You can't. Therefore, it is called non-diversifiable. Which is there into the system is systematic risk. I don't want to dig into it. Understood? This much knowledge is okay. If someone asks me now what is beta, I should be able to say that systematic risk. Whole na, this was full time pass. I will tell you. What is important at this level is only this formula. They will not ask you anything. That though I said. Why? Because so that you can build on this. Okay? Understood? So, understood? Is it clear? This all time pass was going on. I just showed you what is the logic behind the formula. Okay? Understood? So, beta RF plus beta into RM minus RF. RF plus beta into RM minus RF is what? Means what is the return? If I want to speak, and I can speak half an hour. This is a additive model. This is what? Additive model. Why you know? This is additive. This is RF. This is premium. Understood? Adding. What I said about the returns. Returns should be taken as compounded. Means it should be 1 plus RF into 1 plus RP. Something like this. Multiplicative model. But no. CAPM, what is the disadvantage? It takes additive model. It adds the premiums and the risk. Is that clear? Understood? Okay. If I say more na, see, it only considers what? It only considers what? Systematic risk. It only considers what? Systematic risk. Okay. Understood? Chalo, fine. Shall we stop?